Moving countries can be one of the most exciting and most challenging things you'll ever do. And we're here to take one big worry off your plate: your taxes. At Expat Taxes, we understand the complexities of Irish tax from your perspective as an expat and tailor our advice to your needs. With decades of expertise, our team at Expat Taxes will help you navigate tax residency, cross-border taxation, reliefs and returns, and will work with your country's tax advisor to make sure your taxes are sorted. Whether you're an individual or a corporation coming from Australia, the United States, the UK, or anywhere in the world, we want to help you. So visit us at expattaxes.ie to book a consultation today, and let's make moving to Ireland easier together.
Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Hi everyone, hope you're well and welcome to this episode of Tax Bites for Expats. What are we going to talk about today? Well, I suppose it's just me today. Apologies in advance, but I wanted to talk specifically to a group of people that we speak to frequently in the work that we do at Expat Taxes. And that's people who are retiring to Ireland, planning to spend their retirement years here. Two categories mainly: people who maybe have not lived in Ireland previously, but have decided that it's a location they'd like to move to. And then a second category, which would be Irish people who have gone overseas and then returned to Ireland in their retirement years with a view to spending them here. So when we speak to these people, lots of questions come, and I'd like to kind of dedicate this episode to trying to answer some of the ones, specifically the tax ones that come up. And then we'll try and throw in a few little nuggets of information that relate to maybe non-tax issues, life admin, let's call it, that might be helpful for people who are planning their move. So maybe just to start, let's just talk generally about, the tax system in Ireland and what people might expect or should expect when they move to Ireland from overseas. So let's use an example: somebody who decides to move maybe in August of a given calendar year. The Irish tax year is calendar based, so it runs January to December. And when we're trying to determine if an individual is a tax resident in that tax year, the first thing we do is we count the number of days that they have in Ireland in that year. Few points there: any part of a day counts. Days before you actually move here count. So in other words, if you have had a 3-week holiday in advance of your actual move date, we count those days. And what we're looking for is to see if you've gone over the threshold. So the threshold mainly that most people think about is 183 days. If you have 183 days in Ireland in a calendar year, you are a tax resident in that year. The second test, which is not as commonly applicable, but it can be, is when you aggregate time over 2 calendar years, such that you've spent 280 days over 2 years, and you're therefore a tax resident in the second year. So first step, apply those tests. If the answer is you are a tax resident, then we want to look at how Ireland's going to tax you. Why? Well, an individual who's tax resident in Ireland is taxed on their worldwide income and worldwide gains. So going back to our hypothetical retiree, let's say her name is Niamh. Niamh has a US Social Security pension. So once we've worked out that she's a tax resident in the year that she moves, now we need to determine whether or not Ireland is going to actually tax her US Social Security pension. The answer to the question as to whether it will is to some extent related to her domicile, which I don't propose to go into in any detail here. For the sake of this episode, let's assume Niamh, with a name like Niamh, is Irish domiciled. In other words, her parents were Irish and she was born and raised in Ireland, and she went maybe to New York in her late 20s and has planned to return in her retirement years. So Niamh is Irish domiciled. She has a US Social Security pension. She relocates to Ireland and spends 183 days in Ireland in the calendar year she moves. Ireland has taxing rights under our domestic law on her Social Security pension. And most people will grasp that. It's relatively straightforward. And I think where it gets a bit more complicated, or when the questions come, is when we start to look at what's happened in the foreign jurisdiction. So in this case, the US. What we routinely see is that the Social Security pension in the US is already being taxed there. So now we have to look at the double tax agreement, and broadly, the agreement between Ireland and the US gives sole taxing rights on that pension to Ireland. So Niamh now has, I suppose, a few questions. Firstly, she's had to determine if she's an Irish tax resident in the year that she arrives. Secondly, she probably needs to have reviewed what income she has in her year of arrival. And she also probably needs to have a chat with her US accountant, mainly because she needs to let them know, look, I've moved to a country where this income that's been taxed here to date is now going to be taxed in another jurisdiction. So as you can see, it's a bit of a paper trail, conversations with the right people. But ultimately, I would generally say to clients, it's mainly the first year of the move that presents these issues. That's when the questions come. That's when both advisors, the Irish advisor and the US advisor, are having to kind of work out what's happening and when. And usually moving on from that, it's relatively straightforward. Niamh is probably going to ask the question, okay, so what tax am I going to have to pay in Ireland? And that's a really good question. It's going to come down ultimately to the amount of income that she has. We've talked here as if she only has a Social Security pension. Most of our US clients tend to have other income types. Let's say, for example, she has a rental property too. She's decided to rent out her old home in New York. And that rental income is now also going to be taxed in Ireland in the year of arrival if she's a tax resident in that year. Meaning that on her Irish tax return, we will report her Social Security pension and the rental income from the US property. So again, we're going to end up in a situation where Niamh or her US accountant are going to say, so what about the US tax? And that's a really good question. Generally, when we speak to clients, there's a common misconception that tax treaties could be potentially summarised in maybe one or two lines, such as you could only pay tax in one country, or if you've already been taxed on that, Ireland can't tax you again, or you'll get credit and then no further description as to where the credit's given. So I suppose where we come in is helping clients understand how the double tax agreement works. And simply put, there isn't really a line you can deliver to clients to explain it without actually understanding the type of income that the client is talking about. Take, for example, the rental income that Niamh has in New York. She will likely continue paying tax to the federal government on that rental income. She may also have to continue paying state tax to New York State. But because she's triggered Irish residency, she now has her worldwide income in the Irish tax net. So now Ireland wants a slice of the pie too. What that's going to mean is on the first tax return that we do for Niamh, we'll pick up the US rental income. We'll take a certain number of deductions, which may not be the same as what she's used to getting in the US. Report the income on an Irish return and then claim credit for the US taxes that have been paid on the income. And that's basically what the treaty says. It says if you have rental income and the property is located in one jurisdiction, the individual is a resident in another, well, the second country, the place where the individual is resident, gets to tax the income too, but it has to give credit for the tax in the location where the property is. So what does this mean for people who are planning a move? Well, I suppose maybe just to summarise, firstly, be clear as to when you become a tax resident in Ireland. Count your days. Have an idea as to whether or not you're going to trigger residency. And be aware that you can be physically living in Ireland but not yet be a tax resident if you haven't otherwise met the residency rules, which are only days based. Secondly, once you trigger residency, expect that Ireland wants, in the first instance, particularly if you're Irish born and raised, to tax your worldwide income and gains. And then thirdly, be aware that that's going to mean that your foreign tax advisor is probably going to need to have a conversation with an Irish advisor at some point to make sure that the first return, second and third subsequent returns you do and deliver to the revenue commissioners are done correctly. So maybe just a little bit now about the tax compliance process in Ireland. So it's a self-assessment system that we have in Ireland, which means an individual self-assesses their liability to tax. I often describe it as being like an honesty system. In other words, the revenue expect you to report, and you actually make a declaration to that effect on your tax return, which is a legal declaration, that you've disclosed everything correctly. So it's important to get it right. The tax year, as I mentioned at the start, is January to December. And if an individual has to file an Irish tax return, they must do so by the 31st of October in the year following. So, for example, we're working with many clients right now in May of 2024 on their 2023 tax returns. So, top tip, please don't leave it till October to consider your tax issues, because that's not helpful for you, your foreign advisor, or your newly appointed Irish advisor. In terms of registering with revenue, well, usually your accountant or tax advisor will do that for you. You can do it yourself. Please bear in mind, we often routinely get queries from clients who tell us that they've contacted revenue. My personal opinion is that, revenue's function, it's not to serve as a help desk for taxpayers who have complicated international tax questions. So maybe just, if you're finding it difficult to get answers to complicated cross-border tax questions, just be aware that, it's not necessarily revenue's remit to provide you with advice. And you will likely find that if you ask them a question and you ask them to confirm what they've given you constitutes advice, they're quite likely to tell you that it doesn't. Bear that in mind. In terms of revenue generally, so to register, you'll need a PPS number, and you would register to use an online system. Coming back to Neve, for example, Neve would need to use ROS, Revenue's Online Service, so ROS, referred to as ROS. Neve needs to use this because she is what we call a chargeable person, which very simply means she has to pay tax in Ireland, and the tax that she's due to pay has not been withheld at source. Take Neve's niece, call her Mary. Mary's working in Ireland, she has a job, she gets a payslip, she pays taxes at source. Mary doesn't have to do a tax return if she doesn't want to, because she's been taxed at source. She's not a chargeable person. So there's a slight disconnect, I suppose, between maybe the Irish system and some foreign systems where, maybe Australia or the US, you must do a tax return annually. That's not the case in Ireland. You essentially need to make a determination as to whether you have an obligation to file a return. It's not a requirement for everybody. In terms of other non-tax issues, a few other things that Neve might be interested to know. Firstly, when she reaches the age of 70, she'll find her tax rate will fall. Our tax rate generally is a function of how much income that she has, but once she reaches the age of 70, her income level within certain ranges will drop. Her universal social charge, which is the acronym is USC, falls to 2% at certain levels. In addition to that, a recent change, as I understand it, means that she will continue paying PRSI if she turned 66 this year until the age of 70. Previously, if an individual was 66 or over, there was no PRSI, and PRSI is our social insurance charge. It's a flat 4% rate. All of these different acronyms and rates essentially are determining what tax Neve has to pay. So for her to actually tell her categorically what she needs to pay at the end of the year, we need to understand what income she has, where it's coming from, what tax credit she has. But broadly, if an individual who is at retirement age has income of less than €18,000 a year, there's no tax payable. And this is for an individual who's not married. It's double that for a married couple. So there are a few small takeaways about things Neve might be interested in. Another thing Neve might not be aware of, given she's been out of Ireland for a while, is that like with many other countries, both within the EU and out, Ireland has a reciprocal agreement with the US, which essentially will allow a form of aggregation of the social insurance that Neve might have paid when she was living and working in the US with her Irish social insurance record, which probably doesn't look fantastic because, she went when she was relatively young and only worked in Ireland for a few years. So I generally say to clients, don't assume you're not entitled to any kind of an Irish pension simply because you're claiming one overseas. It's always worth contacting the Department of Social Protection, writing to them, telling them that you've worked in the foreign jurisdiction you worked in, asking them to review your Irish record. And my understanding is they then reach out to the foreign jurisdiction to confirm the number of contributions or years you've paid into the social insurance system there, and they make a determination using a calculation to work out what you're entitled to from the Irish Department of Social Protection. So it might not be worth a lot, but it's worth more than doing nothing, even if it's just to get confirmation that you're not entitled to something. The other thing that often gets routinely missed is, and perhaps not as relevant for somebody who's eligible for a medical card, but we have a drug payment scheme in Ireland. So if Neve, for some reason, is spending quite a lot of money every month on medicines from her local pharmacy, it's worth having a chat with them about registering for the drug payment scheme. over a certain threshold every month, she doesn't have to pay for prescribed medicines. So that could be a useful little thing to know. Other than that, I think, in terms of helping Niamh with her tax return, helping her understand what she needs to do to comply and getting the process up and running, generally then the conversation turns to, have we thought perhaps about an Irish will? Is one needed? Have you written a will under US law? What will that mean from a tax perspective in terms of any assets that you hold on your passing? And I suppose when we're talking to Niamh, that's an important conversation. She's Irish domiciled, and what she's going to find is if, for example, she leaves assets under her will while Irish resident to her son, for example, who lives in France, Ireland will seek to tax the inheritance that she leaves to her son if it's over a certain level. That level currently, because of the relationship between Niamh and her son, is €335,000 in terms of lifetime bequests that she makes, including gifts and inheritances to her son. So, assuming as well he hasn't taken anything previously from his father. So the point I'm making is, when you're up and running in the Irish system, when you've got to grips with what your annual tax bill is, when you've lodged that return and you've given revenue whatever they're entitled to after you've taken credit for what's been paid in the US or other jurisdiction, it is always worth sitting down and thinking about planning for the next generation. Because I suppose there are complexities to take into account when somebody comes to Ireland with foreign assets. In Ireland, we only have 2 estate tax treaties, one with the UK and one with the US. So there's quite a bit to that, really. And I suppose what I really wanted to do in this episode was simplify it, because it is overwhelming when somebody is making a move later in life. And I suppose these admin issues, their life admin, they can seem very stressful, particularly at the start. So please reach out to us if you have questions. We offer tax return services to many retirees in Ireland who have moved here or returned here from overseas. And we work with foreign advisors in the foreign jurisdiction. We can recommend one if you don't have one, and we're very happy to work with your existing advisor. And in addition to that, if you want to organise a consultation just to step through how some of what we've spoken about might apply to you, please feel free to reach out and organise that. We're always happy to help, and delighted to see when our clients plan their move well, execute it, comply with their tax obligations. And at the end of it, we so regularly hear from clients who are in the planning phase of their move that they're so happy they made the move and it's been really successful.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.